Well, welcome to this webinar on IAS 12 income taxes. My name is Casey. I shall be taking you through the presentation. It's scheduled for 3 hours, but being a webinar, as opposed to being face-to-face, there is a chance that we might finish earlier. There is going to be a break in between, just a bathroom break, 15 minutes, 25 minutes before we finish the rest of the session. Remember, you can always post your questions onto the platform. I'll be looking at them and responding to them as we go along. So if there's any part or any example that I'm going through that you're not clear about, feel free to post your questions and I'll be very happy to respond. We have a number of case studies that we're going to be using to explain the various concepts. It's mainly going to be focused on deferred tax, although IAS 12 is for income taxes in the broad sense. What are we going to cover? We're going to cover IAS 12, that's deferred tax, plus case studies. The key aspects that we're going to be looking at are two aspects of income taxes, as you may be well aware. The first one is the current tax. That's the tax that is charged on income tax from the receiver of revenue in the respective country, which is more of based on accounting rules. So in South Africa, that's based on the Income Tax Act and the various pronouncements such as the budget and various parliamentary proclamations and so on that come about from time to time. Our greater focus is going to be on deferred tax. Deferred tax, as you would know, unlike income tax, unlike current tax, is an accounting concept. It's an accrual concept, and that's where we're going to be placing our focus. Very rule-based, although we are going to also be looking at the logic and drilling down to the reason for the debits and credits that arise in the deferred tax that explain why we do things the way we do them. So firstly, what is the scope of the standard? The standard says it applies to IAS 12 should be applied in accounting for income taxes defined as including all domestic and foreign taxes which are based on taxable profit, and taxes such as withholding taxes which are payable by a subsidiary, associate or JV on distributions, or rather joint arrangement on distributions to the reporting entity. Now, IAS 12 does not apply to accounting for government grants. So in an instance where an entity receives a grant, say as an income grant, where say an entity is performing charitable activities and and the government writes them a check, they qualify for a grant, or in certain instances, government can decide we're going to be giving, asset-based grants where they say we're going to give an entity, manufacturing entity, a grant to enable them to acquire equipment and so on and so forth. There's a whole separate standard, that's IAS 20, that deals with accounting for government grants or investment tax credits. However, this standard IAS 12 does deal with the accounting for any temporary differences that may arise from grants or investment tax credits. So in other words, as you may know from IAS 20, one of the things that is stated there is, for instance, we do not account for the grant until we have met the conditions. So if, for instance, you receive R1 million and you've not met the conditions are going to be met over a 5-year period, and you determine that that will be accounted for over the 5 years as we meet the conditions, then you would treat that as a liability. Whereas you may find that the tax rules may, for instance, in certain jurisdictions state that the grant is taxable at receipt, and therefore there arises a temporary difference. And we're going to explain these concepts, the concept of temporary differences and what it actually means. So what is the logic behind deferred tax? The logic behind deferred tax assets, the logical elegance behind deferred tax is that Assets generate future economic benefit. That's going to be future income. Whereas if you look at liabilities, it's the opposite. They result in there's a future tax effect that results from an asset. So future economic benefits are going to obviously have tax consequences. So you're going to have future income arising from an asset. So the fact that they're going to have future income means that there's future tax effects, and therefore the purpose of tax deferred tax is to capture that future expense. So it's actually the accrual concept that we are trying to align to. In other words, to ensure that when we capture our incomes, or rather once we have an asset, that the corresponding liability that relates to that asset from a taxation point of view is also of definitions. Temporary difference, it arises because the accounting rules are different from the tax rules. We've already explored that to say that from a current tax perspective, you already have a situation where current tax is based on the Income Tax Act, whereas accounting rules such as deferred income for government grants, fair value adjustments for investment properties, and so on and so forth are based on accounting rules in the relevant accounting standard if we are applying IFRS. So this causes accounting profit and taxable profit to be different, but only on a temporary basis, and that's where a temporary difference arises. So temporary differences can arise when income and expenses are included in accounting profit in one period, but are included in taxable period of a different period. So that shows that the periods that we are including it in accounting profit and the period that we are including it for tax purposes are different periods. And this has a term that we're going to look at later, and the term is a timing difference. In a business combination, you may find that in terms of IFRS 3, carrying amounts of assets and liabilities are adjusted to acquisition date fair values, but tax bases are not affected. And then lastly, when an asset and liability are revalued and the tax base is not adjusted, typically when we are looking at items of property, plant, and equipment. So as we've said, timing differences is what the first one is referred to, the fact that we have something that's included in accounting profits, so say an amount that is only going to be taxed later, but for accrual purposes, we say that we're going to put it in our accounting profit, or the opposite. For taxable profit, in accounting, if we are saying that we're only going to account for it later, such as a government grant, that the income will be brought into our accounting profit later, but the taxman says that we are going to tax it in the period that you receive it, which might be in the current year, then that means that that income is being accounted in different periods, and we have a timing difference. Now, this often happens in practice that we use the terms interchangeably, but it is wrong to do that, because whereas all timing differences are also temporary differences, not all temporary differences are timing differences. So as we've said, in the case of a business combination or an asset being revalued, then those are not timing differences, and as such, they are temporary differences that are not timing differences. Now, you may have heard of the concept of a permanent difference. So a permanent difference means that at no point in time will this difference be reconciled, unlike where we're looking at income, where income in one period is in the accounting profit, whereas it's in the taxation profit in a different period. Now, these permanent differences, there are a number that exist. They are caused by certain items that will never be taxed, or in the case of expenses, they are items that will never be allowed as a deduction. So that means that there is no timing difference. It will not come into accounting, into your taxation profit. So if you look at a fine, or for instance, or a donation, or an entertainment expense that's not allowed for tax purposes, you may find that fines, for instance, the fine, in terms of accounting, it is an expense. So, an entity has got salesmen, as they drive around, they end up they incur traffic fines, for instance. Those traffic fines are expensed in the books of the company as an expense, normal IS1 accounting, it's an expense, it's a cost of doing business because they're salesmen, and this may have arisen from time to time where they end up having to pay fines. From a taxation point of view, the Income Tax Act says that you're not allowed a deduction. So whereas the fine has been included in the accounting profit, it's now not included in the taxable profit ever. And as a result, we have a permanent difference, and permanent differences do not result in deferred tax because they are not temporary. So let's look at delve further into the idea of a temporary difference. Typically, the carrying amount less the tax base is going to give you the temporary difference. So it's the difference between your carrying amount and your tax base. Or if we put it, if we look at the deferred tax consequence of that, is the general rule is that we take the temporary difference, we multiply it by the tax rate, and that gives us our deferred tax asset or our liability. I say this is the general rule because, as you will see as we go along, there are areas where this does not really pan out exactly as that, depending on what the rules are. So the carrying amount is the value from an accounting perspective, whereas the tax base is the value from a tax perspective. Moving on, deferred tax liabilities and deferred tax assets. Now, deferred tax liabilities, the amount of income taxes that are payable in future periods in respect of taxable temporary differences. And if you think about replacing that with the various items, then you end up, defining what a deferred tax asset is. Now, a deferred tax asset is the amount of income taxes that you will recover in future periods in respect of deductible temporary differences. So, deferred tax liability, we are saying that in future you're going to have tax consequences that are going to hurt the pocket of the company. In other words, they are going to be an expense, and therefore they are taxable temporary differences. Whereas the complete opposite is a deferred tax asset. In other words, in future you're going to end up getting a deduction, and therefore it's a deductible temporary difference. So deferred tax liabilities refers to tax to be paid in the future, whereas deferred tax assets, we are looking at savings that are going to be incurred in the future, such as, for instance, if you have an accumulated tax loss that in future is going to give you a tax benefit, then we are saying it's a future tax saving, and therefore we account for it. It's a deduction difference. Now, temporary differences, assets, liabilities, just some diagrammatic representations here that can help you. You'll see in instances where the carrying amount is more than the tax base can give rise to taxable temporary difference as an asset, or deductible temporary difference in the case of liabilities, and the opposite of that at the bottom a bit further. So taxable temporary difference in the case of an asset where the carrying amount, such as say PPE, is more than the tax base, then we are saying there's a taxable temporary difference. Sorry, that's in the case of if you're looking at if you're looking at, for instance, PPE, that means in future we're going to have a bigger tax expense because we've only written down a smaller amount in comparison to the wear and tear that the receiver of revenue has risen. Now, in the case of a liability, a carrying amount may be less than the tax base, in which case we are saying that that results in a taxable temporary difference. So if you think about certain liabilities that have a tax base but have no carrying amount, then therefore it means that from the tax point of view we are going to have a future liability. So in the case of an asset, if we depreciate it more quickly for tax purposes than for accounting purposes, that's the most common deferred tax item that you normally see out there. In the case of a liability, so for instance, a foreign currency loan payable is reduced for accounting purposes by exchange gain taxable when, but an exchange gain is taxable when loan is settled. So in this case, foreign currency loan payable is a liability, as we know. In the instance that has been given as an example, we are saying for the carrying amount, we've basically written it down faster. So we have a smaller amount from the carrying amount point of view, whereas the tax base you find is higher, and therefore you find that we end up with a taxable temporary difference for this liability. Now, you keep using terms tax base, carrying amount. I'm sure carrying amount, you may know what a carrying amount is, but let's look at what exactly the tax base is. Now, the tax base is the amount that is attributable to that asset and or liability for tax purposes, and they have. And here is an example. So, um, as you may see, we may have earnings of $650,000. Our income tax threshold may be 550,000, and therefore we end up having taxable income of 100,000. Now, the carrying amount is what it is for accounting purposes, which is 650. From the tax point of view, the tax base is 550,000. Our 100,000, which generally we should multiply by the tax rate to get our deferred tax amount. The tax base of an asset is the amount that is deductible for tax against taxable economic benefits that will flow when the carrying amount is recovered. Note, if the economic benefits are not taxable, then the tax base is equal to the carrying amount. Remember, I said that there are going to be a number of rules that are applicable here that we need to pay attention to, and this is what we are talking about generally, that in the instance where an amount is deductible for tax against taxable economic benefits, there's two rules. Think of the definition. The definition is an amount deductible for tax against taxable economic benefits that will flow when the carrying amount is recovered. So if you think of an item of PPE, the tax base, if we say it's 100,000, we are saying in future we are going to be able to deduct the full 100,000 over time. When the carrying amount is recovered, that is as we recover the amount of PPE. But if we are saying that the amount of 100,000 is not taxable, then we are saying that the tax base is equal to the carrying amount. For a liability, this is the definition of the tax base of a liability. The tax base of a liability is the carrying amount of the liability less any amount deductible for tax purposes in respect of that liability in future periods. So in the case, say, of that foreign loan payable that we looked at as an example, its carrying amount, the carrying amount, say, is 100,000. What is its tax base? We take the 100,000 and then we ask ourselves how much of that liability will be deductible in future periods. If it's nothing, then it means that we are going to be deducting zero, and therefore the liability is going to end up being the same as the carrying amount. Or if we are saying that the full amount will be deductible, then we are saying the carrying amount less the full amount again, which is the carrying amount, will end up with a tax base of the liability of zero. And then there's a special rule for income received in advance. For income received in advance, the rule is as follows. It is the carrying amount less any amount of the revenue that will not be taxable in future periods. And we have an example up ahead as we go along. So let's look at the impact on the profit and loss statement. Increase in deferred tax liability becomes a deferred tax expense, whereas a decrease in deferred tax liability gives you a deferred tax income. Now, deferred tax expense and deferred tax income are reported in the income tax expense line item. Now, for a non-current asset, the tax base is equal to the original cost less cumulative tax depreciation. In other words, the capital allowance that has been allowed for tax purposes. The taxable temporary difference is the carrying amount less the taxes. And we have our first case study here. It's the deferred tax liability on equipment. Now, an entity buys equipment for $10,000 and depreciates on a straight line basis over its useful life of 5 years. Capital allowance is 25% on a straight line basis. So for accounting purposes, we are saying it's useful life is 5 years, so that means we are taking off 20% every year. For tax purposes, we are saying it's 25% each year. So we need to show the temporary differences and the deferred tax assets and liabilities and the deferred tax expense and income for the 5 years. The tax rate, we are told, is 40%, quite high. And these are our workings. So if we look at our accounting working, we start on year 1, year 2, year 3, year 4, and year 5. We are saying the depreciation because is 20% because, as we've been told in the scenario, that it's a 5-year useful life. So in other words, we end up taking off 2,000 every year. So our carrying amount is going to be the cost less the accumulated depreciation each year. So in year 1, we've only accumulated 2,000. In year 2, it's 4,000. Year 3, 6,000, 8,000. In year 4, and eventually the full 10,000. So our carrying amount for year 1, therefore, is the difference, 8,000, 6, 4, and 2. And eventually our carrying amount becomes 0 in year 5. For the tax base, it's pretty much the same thing, but we've been told that for our tax base, it's a 25% rate. So that's the rate of capital allowance that we are given. So it's over a 4-year period that we write it down. So we end up taking 10,000 less 2,500. We end up with 7.5 in year 1, and it's basically the same thing, but obviously we have fully written it off for tax purposes at the end of year 4. Now let's look at our deferred tax. Our taxable temporary difference, as we've said, is the difference between the carrying amount and the tax base. In year 1, 8,000 less 7.5 gives you 500. In year 2, 6,000 less 5,000 gives you 1,000. In year 3, 4,000 less 2.5 gives you 1,500. And in the last year, in year 4, it's 2,000 less nothing, nil, which is 2,000. And in year 5, for both accounting and for tax purposes, we have a 0 amount, and therefore there is no taxable temporary difference. So, as we've said, what is our deferred tax balance? We've said that you multiply the tax rate times the taxable temporary difference. Our tax rate is 40%, and therefore we take that 40%, we multiply it by a taxable temporary difference of 500. That gives us a deferred tax balance of 200. In year 2, we apply the same thing. We have an opening balance of 200. What is our deferred tax balance? We have a temporary difference of 1,000 multiplied by 40%, and therefore that means our closing balance for deferred tax purposes is 400. Now, because we had an opening balance of 200 at the beginning of the year, and we want to gross that up to 400 at the end of the year, that means we end up having a deferred tax expense that we need to put through the income statement. That means we need to debit our deferred tax expense, and then we need to credit our deferred tax liability, and that's why we end up with 400, and that pretty much ends up being the same in year 3. We're grossing it up to 600. 600 is 40% of 1,500, and 800 being 40% of 2,000. Opening balance less closing balance, we put that through the income statement. Now this is what happens in year 5. We have a balance of 800, but if we take our carrying amount, our taxable temporary difference at this point is 0. 0 times 40% gives you 0. That means we are supposed to end up with a 0 balance at the end of the year for our deferred tax. So what ends up happening? Instead of us passing a expense journal, in other words, a debit to the income statement, we end up with a credit. So our journal entry will be to credit the income statement expense item for deferred tax, and to debit our liability because our liability has grown to 800 and it needs to be 0. How about for assets? Case study 2. Deferred tax liability on asset. So an asset with a cost of 120,000 has a carrying amount of 100,000. Cumulative depreciation for tax purposes is 80,000, and the tax rate is 25%. we need to calculate the deferred tax liability. So somewhat similar to the first example that we are looking at. Now, it's important to think about where we are. We are at a point where we've already depreciated our asset to $1,000. Our cumulative depreciation for tax purposes is 80,000. So we already have a temporary difference, and the tax rate is 20%. So how do we work out our deferred tax liability? As we've said, you take the carrying amount of 100,000, and then we need to work out our tax base. What is our tax base? Remember, we've not been told that our tax base is 80,000. They say that our cumulative depreciation for tax purposes is 80,000. That means that we've already written off 80,000 of the 120 of the cost. And therefore, our tax base is 120 minus 80,000, which gives us 40,000. So carrying amount 100,000, tax base 40,000, multiplied by the tax rate of 25%. That gives you, if you take 100 minus 40, it gives you 60,000, multiplied by 25% will give you the amount. So our taxable temporary difference is the carrying amount less the tax base. Our tax base is the cost less the cumulative tax depreciation. That's 120 less 80 gives us 40. Our taxable temporary difference is the carrying amount of 100 less 40,000 gives us 60,000. Our deferred tax liability is 25% of our taxable temporary difference, and that's 15,000. Now, when the company recovers the carrying amount of the asset through future economic benefits, it will be liable for a tax charge of 15,000 in future, and that is why we are passing a deferred tax journal. So, in case study 3, perhaps we should have had this a bit earlier, but it's fine. Let's just go through it. This is just a case study that's going to look at what happens if we had ignored deferred tax. So let's have a scenario here. An entity with annual profits of $1,200 before depreciation, that's its annual profits, 1,200, and on 1 January year 1 has bought a non-current asset for $500, which has a 2-year useful life. Okay, remember the 1,200 is before depreciation. We have an asset of non-current asset 500, 2-year useful life. That means if I'm to work out the depreciation, I need to write off 250 in year 1 and 250 in year 2. We are saying therefore that perhaps our profit after depreciation is going to be 1,200 less the 250 depreciation. I'm looking at 950 as profit. We're just going ahead. Tax is at the rate of 30%, and the company can claim 100% tax depreciation on it. Okay, so we are saying that for wear and tear or capital allowance, the company can claim 100% once it buys the asset. So if I was to do a tax comp, I'd be saying profit before depreciation of 1,200 less the full 500, which therefore means for a tax point of view, my tax profit would be 1,200 less 500. It would be $700. So calculate the accounting profit for the 2 years without deferred tax and with deferred tax. Okay, fine. Let's look at it. Here's the solution. Now, year 1, I think this is without a deferred tax. Remember, as I said, depreciation is 250 each year. We've been told annual profit each year is 1,200. That means our profit before tax for both years is going to be 950. Now we need to work out what our tax expense is going to be. Our tax expense is here at the bottom. We take 1,200. Remember, we've been told that the capital allowance 100% is allowed in year 1, and therefore, according to the taxman, our taxable profit in year 1 is 700. 700, we've been told our tax rate is 70%. So our tax for year 1 is 210. For year 2, we have no capital allowance because we've already deducted the full amount in year 1. So the full 1,200 multiplied by 30% gives you 360. Let's pop our tax amounts in there. We end up with a profit for the year of 740 in year 1 and 590 in year 2. Now, what about if we are applying the deferred tax rules to that? If we apply the deferred tax rules, then we are going to have a carrying amount of 250 for the asset, but the tax base is 0 because we've already fully taken off the full capital allowance. That means 250 less 0, we have 250. We multiply that by our tax rate of 30%. That means we bring in a deferred tax expense of 75 into our calculation. In year 2, what are we saying in year 2? At the end of year 2, we fully written off the asset. Therefore, we have a carrying amount of 0. Tax base is still 0. Therefore, our deferred tax liability should be 0. That means then we need to pass a journal in the opposite direction, which is to debit the deferred tax liability and credit the income statement. That ends up being 75 in the opposite direction. So what does that mean? At the end of the first year, we have 950 less 210 less 75. We end up with a profit of 665. There's an error here on the slide because I think that 75 in year 2 should not be deducted. It should actually be an addition, because if we take 950, let me just pop it quickly into my calculator. If we take 950 less 360 plus 75 gives you 665. So yeah, so for year 2 it should be an income. So instead of a deduction in brackets, that amount should not be in brackets. Okay. So if you look at the difference in the first year, we had different amounts of income we had the same different amounts of profit for the year. Whereas if you look at now the way we've calculated it, we're ending up with the same amount of profit for each year. And that's the power, or rather the effect, the magic of deferred tax. In other words, we are saying, why should we have the full tax expense accounted for in 1 year, yet in terms of the accrual method, that tax expense is going to be seen, or rather the effect of it is going to happen in future periods, and therefore the tax consequences should not be impacting our performance for the year, because in truth, our performance in terms of accounting, it's not right for us to say that we made less profit or more profit in 1 year than the other. We still made 1,200 at the beginning of the year. 1,200 was our profit. So why should we be showing as a bottom line number a different number from our performance, simply because of different tax rules from our accounting rules? And that's basically the magic of deferred tax. So the key question to ask is, does an asset have a future tax consequence? So if the answer is yes, then the taxable temporary difference is normally the carrying amount and the tax base is equals to 0. If it's not, then the taxable temporary difference is 0 and the tax base is equal to the carrying amount. So if you think about an item, say like land, where you are not going to be allowed any tax deduction on the land. So if we are saying that or any other asset, maybe there's an asset that you have and the taxman says in future you're not going to have any future tax consequence. So if, let's say, it's a receivable of some sort and the receivable has already been taxed, and therefore you have a trade receivable of 100,000, will it have any future tax consequences? No, it won't have any future tax consequences if we're saying that it's already been taxed. Therefore, our tax base is equal to a carrying amount that results in a 0 taxable temporary difference. Now, let's switch gears and look at deferred tax on assets. This is case study number 4. Interest receivable in the statement of financial position is 120. The interest will be taxed on a cash basis. What is our carrying amount? for accounting purposes, we've already been told what our carrying amount is. It's 120. Now, what is the definition of the tax base of an asset? Remember what we looked at earlier. The tax base of an asset is the amount that will be taxable in future periods when we recover the asset. In this case, the interest will be taxed on a cash basis, and therefore we are saying our tax base is 0, because we are saying of the 120, that is only going to be taxed when it's actually received. So for tax purposes, the taxman is saying there's no amount that's in there that at this point is currently taxable, and therefore we are saying our tax base is 0. Therefore, if we are looking at our timing difference, right now our accounting profit is more than our taxable profit, because we've raised the journal entry of credit interest, debit interest received. Our taxman, on the other hand, says, I'm only going to see that you have interest that accrued to you when we actually have it received in cash. So tax profit is 0. And later on, because we've already included our interest in this current year, our accounting profit is going to be less, because we are not going to include the interest again. But now when we actually receive it in future, from a tax point of view, our taxable profit is going to be higher, because that is the year in which that the taxman is going to recognize it as an income. And therefore, later on, our accounting profit is going to be less than our taxable profit. That means there's a future tax charge that's coming and taxable temporary difference, and therefore we need a deferred tax liability to be recognized. So even though our current tax is saying that there's no tax to be recognized, we know from an accrual point of view, we've recognized interest that we are going to be taxed on later, and therefore we are saying for this income, where is the corresponding tax effect? And that's why we recognize deferred tax as an expense and credit deferred tax liability. Now, trade receivables in the statement of future of financial position is 1,500. The revenue has already been included in taxable profit. So this is not like the cash, the interest that we are saying is going to be taxed on a cash basis later. In this particular case, we are saying that trade receivable in the statement of financial position is 1,500. The revenue has already been included in tax profit. So what's our carrying amount? We've been told our carrying amount is 1,500. Of that 1,500, how much of it is going to be taxed in future? We're saying nothing is going to be taxed in future. And therefore, we say if there are no future tax consequences, our carrying amount is equal to our tax base, and that's 1,500. A loan receivable with a carrying amount of $500, the repayment of the loan will have no tax consequences. Quite similar to the one above that, only that with that, the trade receivable has already been taxed. In this particular case, again, we are saying there are no future tax consequences for the loan. Because there are no future tax consequences for the loan, our tax base is 0, and therefore our temporary difference is nil. A machine costs $1,000 with depreciation to date of $300 and a capital allowance of $600 so far. What's our carrying amount? Our accumulated depreciation is $300. We bought it for $1,000, and therefore we are saying our carrying amount is the difference between the $1,000 and the $300. Our carrying amount is therefore $700. What's the tax base? The tax base is the difference between the $1,000 and our capital allowance of $600. It's now $400. What's our temporary difference? Temporary difference is our difference between the two, which is $300. An entity writes down its inventory by $300 to a net realizable value of $5,000. The reduction is ignored for tax purposes until the inventory is sold. Okay? So our inventory, remember what is the rule in IS2? The rule in IS2 that we recognize inventory at the lower of cost and net realizable value. That is the reason for this reduction. So we've reduced it to 5,000. So our carrying amount is 5,000 as we've been given. What is our tax base? Our tax base is, they are ignoring the reduction for tax purposes. That means, therefore, it would be what it was before we wrote it down, which would therefore be 5,000 plus 300, which will be 5,300. Our temporary difference is $300. In this particular case, we have an asset where an asset is more than the tax base, or rather is less than the tax base. The tax base is higher. Therefore, we means we have got more deductions that are going to come about in future. In other words, when inventory is going to be recovered, it's going to go through cost of sales. For tax purposes, they are going to give us a deduction of 5,300, whereas we have already taken out 300, so there's a difference. So in other words, we have more deductions, more tax savings that are coming up in future, and therefore that's a deductible temporary difference. If you multiply that by our tax rate, we end up with a deferred tax asset. So as I said, now we are saying our accounting profit is less than our taxable profit because of that write down to NRV. And later we are saying when we sell it, the accounting profit will be more than the taxable profit. And therefore, we are saying that there is a deduction that we are going to end up having. Hence, it's a future tax relief that we are expecting. So, goodwill is a carrying amount of 12,000. What is the tax base? So, remember what we said. What is the tax base definition? The tax base is the amounts that will be deductible in future for in respect of an asset. In this particular case, goodwill, as we know, is not going to be deductible for tax purposes, or rather, there's not going to be any consequences of goodwill in terms of the tax base. So, sorry, I actually made I think I made a boo-boo there in what I was saying. The goodwill, the tax base is going to be the amount that will have future tax consequences in respect of that carrying amount. Now, goodwill, we say in future, when we recover that goodwill, we're not going to end up being taxed on that goodwill. And therefore, if there are no future tax consequences, the tax base is 12,000, and therefore our temporary difference is nil. Now, development expenditure with a carrying amount of 10,000 US dollars, where the full expenditure has been allowed as a deduction for tax purposes when incurred. This is actually a common example that we have. So we've said our development expenditure is $10,000. Our full expenditure has already been allowed for tax purposes. So if we are saying development expenditure, if we are applying the actual rules under IAS 38, intangible assets, if we have research phase of a project, the research phase is not capitalized. But if it's actual development expenditure, once it meets all the rules, then that is capitalized, and therefore we call that a carrying amount of 10,000. Now, in future, what are going to be the tax consequences in future? What is the amount that in future, is there an amount that in future is going to be have tax consequences for that? We are saying that it's going to be nil because we've already written off, similar to a carrying amount of PPE, we've already written off the full 10,000. So our tax base is therefore 0. We end up with a taxable temporary difference of 10,000, no different from the example that we had under PPE, where we're saying that the capital allowance is given in full in the first year. Now, there's a surplus of $1 million that arose from the revaluation of land with no equivalent adjustment effected for tax purposes. In other words, we've revalued our land by $1 million. We are saying our tax base is 0 for this land because we are saying that there's no equivalent adjustment that's been given for tax purposes. So to explain this a bit differently, let's assume that this asset was 5 million and therefore the carrying amount is 5 million. And then we have a tax base obviously of 5 million if that's the cost. Then in terms of this entity's policy, they say they are going to bring a revaluer. The revaluer comes, he revalues the land to 6 million, so 5 plus 1, it becomes 6 million. For tax purposes, we do not recognize that revaluation. Remember the examples that we looked at of temporary differences. This is one of the temporary differences that arises that is not a timing difference. It's not a time. It's not like an income or or expense that's going to be seen in future. So that revaluation, it's a revaluation of land. Therefore, for the taxman, he remains at 5 million, and that's why it's no different from having 6 million carrying amount, 5 million tax-based temporary difference of 1 million. In this case, we've only we've only included the amount in the example that relates to only the revaluation. So, tax base over liability, we've spent quite a bit of time on assets. Tax base over liability is the carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. Note, as I've said, for revenue or income received in advance, the tax base is equal to the carrying amount less any amount of revenue that will not be taxable in future periods. Here's a case study: deferred tax on liabilities. Accrued expenses of $1,000 have been included in current liabilities but will be deducted for tax purposes on a cash basis. What's the carrying amount? We've been told it's $1,000. What's the tax base? The tax base is 1,000 less the amount that will be deductible for tax purposes in future periods. So we are saying in future, the amount that will be deductible for tax purposes in future is going to be the 1,000. And therefore we are saying our tax base is 0 because 1,000 less 1,000 gives you 0. In other words, now our accounting profit is less because we've accrued the expense. In other words, we debited expenses and credited liabilities. The taxman on his side has not done the same thing, so our taxable profit is more than our accounting profit. But later on, it flips where our accounting profit will be more than our tax profit. So what are we saying? That in future, we're going to end up with tax savings in future when the expense is going to be allowed later. And therefore, we have an asset. We have an asset in our books because we need to show that future tax saving today in terms of the accrual concept. Interest revenue received in advance of 1,500 has been included in current liabilities. The related interest revenue was taxed on a cash basis. Now, remember what we said for revenue received in advance. Okay, so we've been told our carrying amount is 1,500. For revenue received in advance, it's going to be the 1,500 less the amounts that will not be taxable in future in respect of the 1,500. We've been told the related interest revenue was taxed on a cash basis. So in other words, in future, if I take 1,500 less the amount that the amount that will be included in tax in future periods, it's going to be 1,500 less 1,500, which gives us 0. So the carrying amount, what will be the amount that will be, the tax base is the carrying amount minus any amount of revenue that will not be taxable in future periods, So the amount that will not be taxable in future periods is the full amount because we've already been taxed on the amount. So 1,500 less 1,500 gives you 0. We end up with a temporary difference of 1,500. So right now, our accounting profit is less than our taxable profit because we got 1,500. What was our journal entry for accounting purposes? We debited bank, then we credited a liability. For tax purposes, we debit bank and the actual income is included in our tax calculation, which reduces our profit. And that's why we are saying that for taxable profit, we are saying, for taxable profit, there's an income that's reflected. For accounting profit, there's only the liability, which is income received in advance, interest received in advance. And that's why we say our taxable profit is higher than our accounting profit. Later on, our accounting profit will be more than our taxable profit. What does that mean? That in future we are going to have a gain. So because we are going to have a gain in future from a tax point of view, we have a future tax saving that we are bagging right now that we are expecting to be reflected in future periods, and therefore that is a deferred tax asset. Accrued expenses of 1,000 have been included in current liabilities, and they've already been deducted for tax purposes. So this is different from the other one where we said we had accrued expenses which will be taxed, which will only be recognized in future. In this case, we are saying they've already been recognized. Our carrying amount we've been given is 1,000. Our tax base is 1,000 as well. Why? Because if you look at the definition, we are saying that it's the carrying amount less the amount that will be deductible in future. Now, what is the amount that will be deductible in future in respect of this 1,000? It's nothing, because we already deducted it for tax purposes. So 1,000 minus 0 gives us our tax base of 1,000. Accrued fines and penalties of 1,200 have been included in current tax but are not deducted for tax purposes. I think for that we should be saying are not deductible. So it's 1,200 we've been given our carrying amount. Our tax base, sorry, there's an error there. It should not be 120, it should be 1,200, because we are saying what is our tax base? It is the amount, the carrying amount, less the amount that will be deductible for tax purposes in future. We know that nothing will be deductible because we are saying they are not deductible for tax purposes. So so our tax base is going to be 1,200. We end up with a temporary difference of 0. Now, a loan payable has a carrying amount of 10,000 US dollars. The repayment of the loan will have no tax consequences. So if we are saying that the repayment of the loan will have no tax consequences, we are saying that our tax base is therefore equal to our carrying amount, because, sorry, if you're looking at the definition for both number 4 and 5, if you're saying if the amount will have no future tax consequences, therefore the carrying amount is equal to the tax base, coming back to the definition of a tax base in terms of the from an asset point of view, where from a liability point of view, we say in instances where a liability will have no tax consequences in future, then the tax base is equal to the carrying amount. Let me say that again. The tax base of a liability is the carrying amount less the amount that will be deductible in future for that liability. If that amount is not deductible for tax purposes, then the carrying amount is equal to the tax base. That's what we looked at when we're looking at the definition of a tax base of a liability. So accrued fines and penalties and a loan payable, we say they have no future tax consequences. If there are no future tax consequences, therefore the carrying amount and the tax base are going to be equal, the tax base is going to be equal to the carrying amount, and therefore for number 4, correct the tax base to 1,200, not 120, and it's 10,000 for number 5. In both instances, our temporary difference is 0. What about government grants? Remember, I mentioned government grants at the top of my presentation. I said that government grants are not included in IAS 12 because they are accounted for in IAS 20, but like any other asset or any other liability, they can end up resulting in us having deferred tax assets and deferred tax liabilities. Let's look at a case study. A government grant as deferred income. Hopes Limited obtains a government grant of 10,000 US dollars to buy a specified property. Hopes Limited recognizes the grant as deferred income in its statement of financial position, as is allowed by IAS 20, the government grant standard. So 10,000, remember the government grant standard says you recognize government grant when you have met the conditions for the asset, in this, or rather for the grant. In this instance, we are saying we've probably not met the conditions, and therefore we are treating it as a liability until we do. So we are treating it as deferred income. Now, what would be the tax implications based on the following scenarios? Firstly, if the government grant is taxed on receipt, if it's taxed at the same time as it is included in profit and loss, or if it is not taxable at all. If it's taxed on receipt, what are we saying the tax base is going to be? Before looking at the solution, let's look at the definitions. Tax base of a liability is the carrying amount less the amounts that would be deductible for tax purposes in future periods. Now, if it is the if we are saying that it's taxed on receipt, it means it's already been taxed, and therefore we are saying that our tax base is going to be the carrying amount less the amounts that will be taxable in future periods. The amounts that will be taxable in future periods is zero because we've already been taxed, and therefore 10,000 less our future taxable amounts will end up giving us our tax base. So if we look at the example, the first scenario, taxed on receipt, the amount that will not be taxed in future is 10,000 because we've already been taxed. Therefore, our tax base is zero because our tax base is the carrying amount less amounts that will not be taxable in future periods, because the amount that will not be taxable in future periods is the full 10,000. So 10,000 less 10,000 gives us a tax base of zero, and therefore we have a deductible temporary difference because 10,000 carrying amount and a tax base of zero gives us 10,000. If we multiply that by our tax rate, then we end up having our deferred tax asset. It's recognized subject to IAS 12's general recognition criteria, which we've not mentioned so far, that for a deferred tax asset, you don't just recognize an asset, you need to recognize an asset only to the extent that it can be recoverable in future periods. The initial recognition exception does not apply. Again, we're going to look at that because the receipt of the grant affected our taxable profit. Now, our second part, we were saying that government grant taxed at same time as recognized in profit and loss over the life of the asset. Now, all of the grant is taxable in future periods. In other words, the taxes and the accounting have the same recognition process. So all of the grant is taxable in future periods. So the tax base will be equal to the carrying amount. Again, coming to the definition. The definition for a liability. The tax base of a liability is the carrying amount less the amounts that will not be taxable in future periods. In this particular case, the amounts that will not be taxable in future periods, we are not having that because we are saying that the full amount is going to be taxable in future periods. So in other words, we are saying that our tax base is going to be equal to our carrying amount, 10,000, 10,000, and therefore there will be no temporary difference. Now, what if the government grant is not taxed? As we've said, if the government grant is not taxed, the tax base is nil, and consequently a deductible temporary difference will arise. However, because this arises on initial recognition of the deferred income, the conditions and IAS 12 are met and no deferred tax is recognized. Now, we've just knocked that up on you because we had not really discussed these exceptions. They're going to come up. So just mark that. We are saying for this particular one, we are saying that there'll be a temporary difference. Yes, we accept there'll be a temporary difference, but there's an initial recognition exception or an initial recognition rule that exists. And this is what the rule says. The rule says if there is a transaction happening that affects neither accounting profit or tax profit on initial recognition, we do not recognize deferred tax except for certain conditions, and government grants is not one of them, and therefore no deferred tax is recognized. Deductible temporary differences. General rule, a deferred tax asset should be recognized for all temporary deductible temporary differences or unused tax losses and tax credits to the extent that it is probable that taxable profit will be available against which they can be utilized, unless it arises from initial recognition of an asset or a liability in a transaction that's not a business combination and or at the time does not affect accounting or taxable profit. So that's what we were talking about in the previous slide. First of all, we check, and we have actually a flow chart that we're going to look at to check whether or not we can be able to recognize this deductible temporary difference or any temporary difference for that matter. What about tax bases without an associated carrying amount? So the tax base exists, the carrying amount is zero. Think of an example of that. If you said assessed losses, that would be spot on. That's the number one that I remember from my auditing days that I used to see in most of our deferred tax computations. Research costs, that's another example. It's expensed when it's incurred for accounting purposes, but it's allowed for tax purposes in later periods. I don't know if that's really the rule, but in certain instances, depending on what your tax specialist would tell you, would be able to explain to you for certain intangibles that may be true. So a tax base exists. In other words, we have future deductions that are coming, but our carrying amount is zero. So we spent 100,000 on research. In terms of our rules that come up, we say in terms of IS 38, if you're just doing research, then that amount is expensed when incurred. For tax purposes, we say that for the taxman might say, for research, I'm going to allow you don't get a full deduction in your first year. I need you to capitalize that amount and you can write it off over 3 years or 4 years. So in other words, for tax base, we're going to end up having a tax base because tax base for accounting purposes, it's an asset. We say for an asset, the tax base is the amount that will be deductible that will have future deductions, and our carrying the amount that will have future deductions is the full amount as at inception because maybe we are writing. And therefore, in that particular instance, before we move on, we would have said that carrying amount is zero. Our tax base at the end of year one would maybe be 66,666 because we've deducted a third of it. If our carrying amount of an asset is zero, our tax base is 666, or rather 66,000. That means that we have deductible temporary difference, which should give rise to a deferred tax asset. Here, the recognition principles, taxable temporary differences. As I've said, general rule, same thing with deferred tax liability, deferred tax asset. Deferred tax liability should be recognized for all taxable temporary difference, again, unless it arises from the initial recognition of an asset or a liability in a transaction that is not a business combination and at the time of the transaction affects neither accounting profit nor taxable profit. And also the initial recognition of goodwill, we do not have deferred tax on it. So if you think of IFRS 3, where you go and acquire an entity, in terms of IFRS 3, we are supposed to perform a purchase price allocation where we take the carrying amounts of all the assets acquired, we fair value them. There'll be differences between the carrying amounts and the fair values that results in deferred tax, and whatever remains becomes goodwill. The excess of the purchase price becomes goodwill. Now, goodwill, generally, we would then end up having a tax base of zero, but a goodwill amount of whatever amount it is, which we should recognize technically deferred tax on it. Now, the accounting rules say that goodwill, we do not have a deferred tax on goodwill. And the reason why we don't have deferred tax on goodwill is because it's a residual. So we'd end up having a spiral, because if we take goodwill, we apply deferred tax to it, then it means then our goodwill amount changes again, and therefore we need to apply goodwill to another new deferred tax amount as a residual, and so on and so forth. It would never end. So the general rule, if we continue, a deferred tax liability should be recognized for all taxable temporary differences associated with investment in subsidiaries, branches, associates, and joint arrangements, except to the extent that both of the following conditions are satisfied. If the parent is able to control the timing of the reversal of the temporary difference, and if it's probable that the temporary difference will not reverse. So if you think of an entity is a subsidiary, we are going to be able to control when that reversal is going to happen, because we are the ones who control the investment. We can decide when we want to declare dividends, we want to sell the subsidiary, and so on and so forth. If we can be able to control that, therefore we can control the timing of the reversal of the temporary difference. And if we believe that we are not probably going to do it anytime soon, therefore we don't recognize deferred tax. That's what we allowed. Now that applies very well to subsidiaries, but to branches, associates, and joint arrangements, maybe not so much, because remember, in terms of the rules of IFRS 10, something is a subsidiary because we can unilaterally determine what happens with a subsidiary. So in other words, we can control it. But if you think of associates or joint arrangements, we have significant influence or we have joint control. So it's not all within our power. And as a result of that, for associates and for associates and for joint ventures, the likelihood is that we're going to end up having deferred tax because of our lack of control. A deferred tax asset, as we've already covered this, there is a couple of things you need to look at. Firstly is that the taxable profit will be available against which they can be utilized, and if it arises for initial recognition of a transaction that's not a business combination, and at the time of the transaction affects neither accounting profit nor taxable profit, then we are saying not end up having a deferred tax asset. And here's a decision tree that can help you in terms of the IRE, that is the initial recognition exemption. Temporary difference arising on the initial recognition of an asset or liability. Here's the example of an initial recognition of an asset or liability in IS. This is 0. The taxable temporary difference is carrying amount. IS 12 prohibits the recognition of a deferred tax liability, as the initial recognition of an asset is not part of a deferred of a business combination, and it doesn't affect accounting profit or taxable profit, because there is no deduction against taxable profits for this asset. And therefore, we are saying in terms of the initial recognition exemption, that is 12. Now, what about deferred tax on revaluation of assets? Assets revalued upwards, affecting the carrying amount of assets under accounting rules, but no adjustment is made for tax purposes because there is no impact on the tax base. Here's a case study. Revaluation of property. Holt Limited has revalued a property with carrying amount of $4 million US by $5,000 during the current reporting period, and its cost was $4.2 million with a tax base of $3.8 million. The tax rate is 15%. Explain the deferred tax implications on Holt's financial statements of the end, at the end of the current reporting period. So let's follow it closely. The item, it's been revalued. We've revalued a property with carrying amount of $4 million by $500,000 during the current reporting period. We bought the asset at 4.2. Our tax base is 3.8. In other words, this property is obviously being also written down for tax purposes. We've come down to 3.8. We had bought it for 4.2. We've revalued it by 500,000 during the current reporting period. So my understanding of that is that the asset is now sitting at 4.5. So carrying amount correct, 4 million is the carrying amount. We've revalued it to 4.5. Tax base is 3.8. Our taxable temporary difference is 4.5 less 3.8. Now, we need to be careful here because that 700,000 arises from a couple of things. There's a part that arises from just the cost less the tax base, which is obviously the 4 million less the 3.8. And then there's a part that arises from revaluation, which is the full 500,000. The deferred tax liability correctly is 105,000, but we need to split it. 200,000, as I've said, arises due to accelerated tax depreciation allowed. So that relates to our statement of profit and loss. That is an income statement temporary difference. Remember, the revaluations goes through other comprehensive income in terms of the rules of IAS 1. And therefore, the deferred tax needs to follow it there. The deferred tax on the 500,000 arises through revaluation. So the deferred tax of 75,000, that's 15% of 500,000 should be charged to OCI, with the remainder going to P&L. Deferred tax liability of 5 million, this is case study 7B, brought forward. Revaluation surplus was 30 million. New depreciation charge of 2.24 million. Depreciation based on historical cost 800,000. Income tax for the year is 10 million. Deferred tax at year end is 14.56. Tax rate 25%. Lots of information there, quite a mouthful. Let's go through it slowly. So we have a deferred tax liability of 5 million, right? That's brought forward. And the last sentence says deferred tax liability at year end is 14.56. So they've given us the opening balance and the closing balance of deferred tax. Great. Revaluation surplus to date is 30 million. That's on the statement of changes in equity. Our new depreciation charge for the asset is 2.24 million. Depreciation based on historical cost is 800,000. So our depreciation charge is 2.24 million, of which 800,000 is historical cost, and therefore obviously the difference of 1.44 million is actually the depreciation that we are going to apply against, or that relates to the revaluation surplus. Income tax for the year we've been given is 10 million. In other words, that's our income tax expense is 10 million. Now we need to prepare schedules for deferred tax, income tax expense, and financial statements extract. We assume IAS 16 revaluation transfer rule applies. Okay, there is our deferred tax liability, as we've said, opening balance. This was given to us, 5 million, closing balance of 14.56. Income tax expense, we've been told our income tax expense is 10,000. Our current year tax is 10 million. Our first working is we need to work out what our deferred tax on our revaluation surplus is. We've been told it's 30,000. Our tax rate is 25%, so 7,500 goes through our deferred tax on revaluation reserve, which is deferred tax. That means our balance of revaluation reserve should be 22,500 after deferred tax. The 7,500 relates to other comprehensive income, and therefore we know our revaluation reserve, we need to raise a journal entry. We need to, in terms of our liability, we need to credit our liability, and we need to debit our OCI because it relates to our revaluation reserve, so it's actually an expense in our revaluation reserve. Our depreciation, we've already been told, is 2.2 million for the full year. The depreciation relates to both income statement items and it also relates to revaluation. So we've got on historical cost, that's our income statement side, our P&L side is 800 that was given to us. Our total depreciation is 2.24. That means the excess depreciation is 1.440. That relates to the OCI side of things. So that 1.440 item goes against our in our statement of changes in equity, and we basically split it up. We've got deferred tax 75% of 14.4 goes is 1 million to our revaluation reserve. 25% because we need to allocate that 1.44. We need to work out deferred tax on that amount, which is 25%, which is the tax rate, and that's our deferred tax liability, which therefore obviously is what is part of the reconciling items that have gone through our deferred tax comp, the excess depreciation. It's actually a credit because obviously it's an expense. So if it's an expense side, it's actually reducing our asset, and therefore the 25% of that is going to be an income side. So we're actually reducing the 14.4. We're splitting it into two. So our journal entry there would be to debit our deferred tax liability and to credit our statement of changes in equity in order to split that 14.40. So now we know the difference because we've been told 5 million opening, revaluation reserve 7.5 million, excess depreciation 3.6. That means our 2420 is the deferred tax amount that does not relate to the revaluation reserve. So that 2420 is our deferred tax expense, and that deferred tax expense is going through our income statement, which is 2420. We marry that with our current year tax expense. It's a current tax. That means our total tax expense for the year is 12,420. And the 1080 and the 14.40, those are on our statement of changes in equity. So if we look at our statement of changes in equity, and we're told to prepare our income statement of changes in equity, we've got therefore the 12,420 goes through our statement of profit and loss and other comprehensive income as the expense, and then the 1080 and the 1440 go through our statement of changes in equity. Now, what about measurement? Deferred tax assets and liabilities shall be measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled, based on tax rates and tax laws that have been enacted or substantively enacted by the end of the reporting period. So important here, what we are going to look at is basically we need to look at the periods in which the rates were enacted. Needs to be substantially enacted. This happens a lot with the budget, where a budget speech is made and the Minister of Finance surprises us either by an increase or a decrease, saying we're going to increase the tax rates or we're going to reduce the tax rates, and therefore that enactment results in a question of how we're going to apply. Should we use the new tax rate or should we use the current tax rate before the new one has come about? If the standard says we need to use the expectation that's going to come about. So we need to apply our minds to that and see what is actually substantively enacted. It could be an announced tax rate or the existing tax rate. Deferred tax assets and liabilities are measured based on the expected manner of recovery, that's for an asset, or settlement for a liability. And it's related to management intentions. This happens a lot with property, plant and equipment, for instance, where we ask ourselves whether we are going to recover through use or whether we are going to recover it through sale. Change in tax rates. Companies are required to disclose the amount of deferred taxation in the taxation expense that relates to change in tax rates. All right, we are going to look at that after a break. I think I've been talking for quite a while now. We've been going for about an hour, 20 minutes, so it's time for a break. We're just going to take a quick 20-minute body break. or get coffee if you require some. I know deferred tax requires a drink, something strong, not too strong. So maybe have some coffee. In 20 minutes time, we shall reconvene and carry on with the remaining slides. And we're going to start actually by looking at what I've just introduced, which is the concept of enacted or substantively enacted in terms of tax rates, as well as looking at the management intentions. We've got a few examples on that. Some questions, we're going to respond to them as you type them on the platform. I shall be responding to those questions. I think there are some I may have already done so. So we shall reconvene in 20 minutes time. Well, welcome back from the break. Trust we're all re-energized, refreshed to carry on and finish this 3-hour session on deferred tax. We're about halfway through with our learning. Let's carry on with a case study. We're looking at changes in tax rate. Commons Limited statement of financial position as at 31 March 2018 includes interest receivable of $3,000, which will be taxed when received, being during the year ending 31 March 2019. At 31 March 2018, the tax rate is 15%. So before we move on, let's just digest that part. Interest receivable, that's the carrying amount. We have 3,000. We are saying that in future, it's going to be taxed when it's going to be received. So from a tax point of view, that would result in a tax base of 0. Why is that? Remember what we said, that we are when we are looking at an asset, the tax base of an asset is the amount that will be taxable in future. So because we are saying that this amount will be taxed when it's received, then therefore we are saying that the amount is going to be 0. At 31 March 2018, the tax rate is 15%. On 10 April 2018, it is announced that the tax rate for 31 March 2019 will be increased to 17%. The change is enacted as at 20 April 2018. The financial statements for the year ended 31 March 2018 are authorized for issue on 30 June 2018. Explain and determine the deferred tax impact. Now, what rate, the crux of this question is asking ourselves what rate is applicable. As at year end, our tax rate is 15%. On 10th April, that's 10 days later, it is announced that the tax rate will be increased to 17%. The change is enacted on 20 April 2018, and our financial statements for the year end 31 March 2018 only authorized in 30 June 2018. So the question is, what rate should we apply? Should we apply the rate that was applicable at of 15%, or the one that was enacted there afterwards? The taxable temporary difference is the interest receivable of 3,000. As at the end of the year, we apply 15% of 3,000 as our deferred tax liability. The reason for that is, other than using the 17%, we don't use the 17%, and the reason for that is because IAS 12 precludes using 17%, as the rate was neither enacted nor substantively enacted as at 31 March 2018, although it is known at the time that the financial statements are authorized for issue. If the change is significant, we know under IAS 10, that's the subsequent events or events after the reporting period standard, we are supposed to disclose significant events. So if it's a significant impact, if that 2% of the deferred tax liability will change materially because of that 2%, we would need to have disclosure to that effect. Okay, let's look at another example. The following information relates to dollars as at 31 December 2018. The carrying value is 500,000 of non-current assets, and the tax base is 380,000. Tax losses, we have tax losses of 105,000, which obviously are going to have a future tax impact. And this is the information that we've been given. This is, I suppose it's a bit of an extreme example. You're not going to really see this in practice, but it helps us in understanding the concepts. Now, the tax rates enacted by the 2017 year end. In 2018, that's the year that's applicable. We have 25%. 2019 is 23%. 2020 is 21%. And 2021 is 20%. The loss above is the tax loss that was incurred in 2018. The company is very confident of the trading prospects in 2019. The temporary difference is in respect of non-current assets is expected to grow each year beyond 2021. So what are we saying? We are saying that the temporary difference that we have currently for non-current assets is supposed to grow each year beyond 2021. So 2021 and beyond. Now, remember these tax rates have been determined in advance. So the government has said for the next 5 years we are going to be reducing tax rates over a certain stepped period. It will be 25% in 2018, 23% in 2019, 2020 it will be 21%, and 2021 20%. Okay. Losses may be carried forward for offset, 1/3 into each of the next 3 years. So a third of the losses may be carried forward to offset the profits into the next 3 years. So we are at the end of 2018. So we are saying the 105,000 we can carry forward into 2019, 2020, and 2021 equally. Calculate the deferred tax provision that is required at 31 December 2018. Now for our non-current assets, we have a temporary difference of 120,000. For our losses, we have 105,000. So it's basically a tax base without a carrying amount. So that our losses would give us a deferred tax asset, and our non-current asset will give us a deferred tax liability. Now, the deferred tax liability, we apply 20% to it. Why is that? 20% was the rate at the end of 2021. For 2021, remember they said in the scenario that 2021 and beyond, this deferred tax liability is expected to keep on growing, or rather to grow beyond that. For our deferred tax asset, it's reversing over 3 years. So we use the tax rates that are applicable to each of those years, because remember we said it's reversing over a 3-year period. So we use 23%, 21%, and 20%. So our liability is 24,000, and those are our various asset amounts over the working out split over the next 3 years, and therefore we end up with a net liability of 16,000. The tax rate should reflect the tax consequences of the manner in which the entity expects to recover or settle the carrying amount of its asset and liability. Change in tax rate again, a non-current asset, we have a carrying amount of 460,000, a tax base of 320,000. You have accrued interest, there's a receivable of 18,000 and a liability of 15,000. The balance on deferred tax account as at 1 Jan 2018 is was $10,000. They don't tell us whether that is a liability or if it was an asset. I would assume it's a liability. Okay, this was calculated using a tax rate of 30%. During the 2018 year, the government announced an unexpected increase in the level of corporate income tax up to 35%. Now set out the note showing the movement in the deferred tax account, showing the charge to P&L, and clearly identify that part of the tax charge that is due to an increase in the tax rate. So you need to split to show what is relating to the increase in the tax rate and what is not. Okay, so before looking at the solution, we are saying with non-current assets, we've got 140,000 as our temporary difference. And then for accrued interest and payable and receivable, we've got 18 and 15. Now, we know that the tax rate, it was enacted upwards by 5%. So what we need to do is to work out our deferred tax based on the old rate. What is it? And then we need to work out the deferred tax based on the new rate, and the difference between the two is what we would allocate to the change in tax rate. Or in other words, you could do the 30% and then you work out for the change in tax rate, it would be a further 5%. Let's look at it. So at the beginning of the year, we had a 10,000 deferred tax liability. We restate that 10,000 into 11,1167. So in other words, we take the balance as at the 30%, and then we work out what is it based on the 35% rate. So our opening balance would be 11667. In other words, the change in tax rate has increased our opening balance by 1,667. So if we do our deferred tax calculations, we've got two assets, the receivable and non-current assets that give us liabilities of 140 and 18, and then we've got 15,000 as our temporary difference. If we work out 35% of that, we end up with 55,300 as a liability. It should be DTL, not DLT, and our DTA is 5250. And we are saying therefore our closing balance is 50050, a liability, which is what is going to be our closing balance. It means that our journal entry through P&L is 383 or 3838. What about intangible assets with an indefinite life? This is an interesting one. Now, for the purpose of IS 12, these are not considered non-depreciable assets. Indefinite does not mean infinite. So generally in tax law, we say that if you have a brand, for instance, in accounting, we say a brand like Coca-Cola can be there forever. So it's it's an infinite life or indefinite life asset. Whereas for tax purposes, you find that they give you a time period over which you'd be deducting it. Temporary differences will be recognized based on the expected manner of recovery. Here's case study number 9. Intangible assets. K Limited has a brand name with an indefinite useful life. Its carrying amount is its original cost of 600,000 US dollars. The local tax law allows the brand to be amortized at 10% per annum. So it's being written off over 10 years. As at the end of 31 December 2018, its tax base after 3 years tax amortization is 420. Yeah, that's correct because we're writing off 60,000 every year. 60 times 3 is 180. From 600,000, our balance is 420. This tax base is either deductible over the life of the asset or upon sale. The tax rate to trading profits is 15%. There is currently no intention to dispose of the brand, and therefore the brand is expected to be recovered through use. Okay. Explain whether the above will give rise to a deferred tax liability. Okay, so we are saying that we are not going to sell it, we're expecting to use it, and we're expecting to use it indefinitely. So under S12, deferred tax should reflect the expected manner of recovering the asset. Our expected manner is through use. Our taxable temporary difference is 180,000. Deferred tax of 15% times 180,000 is 27,000. It is not a non-depreciable asset under IS 12. Unlike, say, land, which is a non-depreciable asset, which then we are saying that land generally is one that is not going to, in terms of accounting logic, we're not saying that land will end up being of zero value. In terms of IS 12, we're saying it's not asset, so deferred tax would result. Now, what about investment properties at fair value? IS 12 has the rebuttable presumption is if it's an investment property, you're not using it like property, plant and equipment or owner-occupied property that you're going to recover through use. So you can rebut it. A rebuttable presumption means that you can be able to challenge it, but generally the presumption is we presume that the carrying amount will be recovered. So in other words, if you have a different tax rate for sale and a different tax rate for use, then in terms of the rebuttable presumption, we are going to end up using the percentage that relates to the sale. So like in South Africa, we have a capital gains tax rate. That's what we are going to use for investment property, because of the presumption that it's going to be recovered through sale. What about pension liabilities? Pension liabilities accrued in the financial statements but allowed for tax when the contribution made to the pension fund at a later date. If we look at share options, then share options are included in profit or loss, but tax deduction is obtained when options are exercised. What about discounting? Discounting, in other words, should we take deferred tax? If we say that the deferred tax is going to be payable in 3 years' time, should we then discount it to get a present value of the amount? This is a general rule. The general rule is that we prohibit discounting of IS in terms of IS 12 in the measurement of deferred tax and liability. So it's not like a provision where you say, Okay, this deferred tax is going to be, we are saying that we are going to be able to sell, we think we are going to sell this land in 10 years' time. Therefore, the liability that we are going to incur is going to be, 30,000, and we take that 30,000 and we discount it back to present value. It's a rule in IS 12 that we do not apply discounting. There's no discounting. It's actually prohibited. It's not like an exemption. It's actually a All right, let's look at group accounts, associates, and joint arrangements. A temporary difference arises when the carrying amount of an investment in subsidiary, branch, or associate or joint venture is different from the tax base. I've already explained this to say that the carrying amount in the consolidated financial statements, it's the investor's share of the net assets of the investee plus purchased goodwill, but the tax base is equal to the cost of investment. Unremitted earnings, that is basically the undistributed profits which will come through to us as the holding company by way of dividend declaration in the accounts of the investees cause a temporary difference, hence a deferred tax, as unless the parent investor or venturer is able to control the timing, and it's probable that the temporary difference will not reverse. An investor can control the dividend policy of a subsidiary, but it's highly unlikely and not always the case with other types of investments. This means that deferred tax usually does not arise on investment in subsidiaries, yes, because we are saying that the exemption would be applicable, but may on investments in associates and so in terms of group accounts for associates and joint arrangements, group accounts, investment and undistributed earnings, fair value adjustments, and intra-group transactions. And for associates, it's investment and undistributed earnings. If you think about how the accounting is done, let's delve a bit deeper. Fair value adjustments, group accounts, investment in subsidiaries. Temporary difference is the carrying amount less the tax base, obviously. The carrying amount of a subsidiary is the share of the net assets at reporting date plus goodwill. The tax base is you use the applicable tax rules, is probably the cost of the investment up until you dispose the investment. The parent can control the dividend policy of the sub, and therefore if you can determine that dividend of the sub, it is probable, and you know that it's probable that you will not distribute in the foreseeable future, then you do not recognize deferred tax. What about when a parent requires its sub to remit only a portion of undistributed earnings? Therefore, then you recognize deferred tax asset for that portion of undistributed earnings expected to be remitted in the foreseeable future. So the sub has got reserves of $1 million US. We say that we expect in the next 12 months 100,000 of that will come through to us as a dividend and is going to have tax consequences. Then deferred tax at year end is going to recognize to the extent of the 100,000. What about the deferred tax impact when a sub is classified as an IFRS 5 disposal group or non-current asset held for sale? A deferred tax asset should still be recognized subject to the general rule. Remember, the general rule is if we are saying that for deferred tax asset, one that does not result in the initial recognition of, does not affect profits on day one, then therefore it's not, there's no deferred tax that's recognized. And then in the case of a subsidiary, we need to also apply the rules when we are looking at the probability of the recoverability of the deferred tax. Still on fair value adjustments on consolidation. IFRS 3 requires assets liabilities to be measured at acquisition date fair values in group accounts, but no equivalent adjustment is made for tax purposes, and therefore a tax temporary difference arises. I already touched on this earlier. Remember IFRS 3, when you acquire an entity where there's a business combination, you need to apply the purchase price allocation. In other words, I paid $1 million for this bunch of assets. I need to fair value each and every asset, and that's how I bring it into my books. And the difference is goodwill. And therefore, the fair values, if I say fair value of this vehicle, I recognize it at fair value. and yet its cost was something else, it results in a deferred tax impact. Temporary difference is the carrying amount less the tax base, and the carrying amount is the fair value. What are the accounting journal entries? Accounting entries for resulting deferred tax on fair value gain or fair value loss, it depends. For fair value gain, there'll be a deferred tax liability. So if the fair value of the vehicle, for instance, that was bought as part of this business combination is higher than the carrying amount, then therefore we have a smaller tax base and therefore we have a deferred tax liability. Debit goodwill and credit deferred tax liability. This amount reduces the amount of goodwill, and that's why we say we cannot be able to apply deferred tax to goodwill, because then we'd be debiting goodwill and crediting liability, and then goodwill changes and so on and so forth. Deferred tax liability is the fair value gain times the tax rate. Fair value loss is pretty much the opposite. A deferred tax asset arises for a fair value loss. So in other words, the carrying amount is 100,000. We fair value it at 80,000. It means we end up having a tax base that is higher than the carrying amount of the asset, and therefore it's a deferred tax asset, and the credit goes to goodwill. Debit the fair value loss times the tax asset. Intra-group transactions. Unrealized profit is eliminated in group accounts, but the same adjustment is not usually made to the tax base of the inventories, as tax is normally based on an individual rather than group perspective. Therefore, a temporary difference will arise. By eliminating the tax liability, a deferred tax asset will arise. Unrealized profit is the deductible tax temporary difference. It's equal to the carrying amount in group accounts less the tax base, which is the cost to the subsidiary. Case study 10, unrealized profit. On 1 July 2017, PAPS sold goods costing 60,000 to its overseas subsidiary SOP for 95,000. So to the group, it still remains 60,000 because that intercompany sale will be eliminated. At year end, SOP still holds the inventories. In the jurisdictions in which PAP and SOP operate, tax is charged on individual entity profits. That's common. That's the same here in South Africa. PAP's rate of tax is 15%, while SOP's rate is 20%. SOP is entitled to a future tax deduction for the amount paid for the inventories. Explain the deferred tax treatment in the group accounts as at the end of the year. Okay, so the transaction generated unrealized group profit of $35,000, which are eliminated on consolidation, of course, because it's an intra-group transaction. In consol financial statements, the carrying amount of unsold inventory is a cost to the group of 60,000. The tax base of unsold inventory is 95,000, being the cost of the inventories to SOP. So if you're looking at SOP's books, SOP bought it for 95,000 in its own separate books. That's the tax base, and therefore the carrying amount in group financials is 60,000. I currently have a tax base, which is a cost to SOP of 95,000. I have a deductible temporary difference of 35,000. Should we use 20% or should we use 15%? Of course, we use the tax rate that's applicable to SOP, because it's SOP that is accounting for that is holding the inventory. SOP's rate, as it is entitled to the tax relief in future when goods sold outside the group. So that gives us a deferred tax asset of 7,000 to be recovered in future when SOP actually sells it out of the group. In consol statement of financial position, a deferred tax asset of 7,000 is recognized, which is the tax rate of 20% times the 35,000. Debit deferred tax asset in the consolidated statement of financial position, and then you credit the consolidated statement of investment in associates and distributed earnings. As we know, deferred tax in associates and distributed profit of an associate is subject to deferred tax. Since the investor cannot control the investee, that means therefore deferred tax is going to arise. We can't have that exemption where we say, oh, I can be able to control the timing of the reversal of the things. So the carrying amount is the share of the net assets at reporting date plus goodwill. The tax base is the cost of the investment typically. The equity accounting, in terms of equity accounting, we know the cost plus profit should be equal to the net assets plus goodwill, because in terms of equity accounting, what we do, we have investment in associate that we put on day one, and then with all the equity profits that come through the year, or it could be losses, it either increases or reduces that investment. The tax base plus profit is equal, therefore, to the carrying amount. Profit is equal to carrying amount less the tax base. Let's look further at unused tax losses. When an entity has unused tax losses, IAS 12 allows a deferred tax asset to be recognized only to the extent that it is probable that future taxable profits will be available against which the unused tax losses can be utilized. IAS 12 states that the deferred tax asset should only be recognized after considering whether an entity has sufficient taxable temporary differences against which the unused tax losses can be offset, whether it is probable that the entity will have taxable profits when the unused tax losses expire, or whether the tax losses result from identifiable causes which are unlikely to recur. So obviously, if we expect losses to keep happening, then we can't make the argument that we expect that it's going to reverse. So otherwise, the existence of unused tax losses is strong evidence that future taxable profits may not be available. Whether tax planning opportunities are available to the entity that will create taxable profit in the period that the tax losses. In terms of presentation and disclosure, the tax expense income should be presented on the face of the income statement that we know. The major components of tax expense should be disclosed separately in a note. So in other words, we need to say current tax and deferred tax charged and credited directly to equity should also be shown. And also for point number 2, we need to show the split between current and deferred tax. The amount of income tax relating to each component of other comprehensive income is also required to be disclosed. We need to explain a relationship between the tax expense or income and accounting profit in either or both of the following forms. So you can do it numerical reconciliation of tax expense. So to say, if my profit before tax is 10,000, our tax rate is 28%, so I expect my tax expense to be 28,000, but my tax expense maybe is 21,500, and therefore I need to reconcile between 28,000 and 21,500. I need to show separate line items as to show why I end up with 21,500. And the chief cause for this is permanent differences that result. Deferred tax does not result in a reconciliation, because generally if the only things that you have are timing differences or temporary differences, then the deferred tax effect should normalize your tax. Remember, as we looked at that example where we're looking at tax without deferred tax and tax with deferred tax, you see that the deferred tax is actually an equalizer that brings you back to the 28%. A numerical, you can either do that recon from 28,000 to 21,500, in other words, using numbers, or you can do it using tax rates. Excuse me. You can use the tax rates. In other words, you can, instead of having 28,000 coming down to 21,500, you can be able to use percentages to say it should be 28%. It's currently reflected as 21.5%, and these are the reasons for the changes. You should also have an explanation of changes on the applicable tax rates compared to the previous accounting period, the amount and expiry date, if any, of deductible temporary differences, unused tax losses, unused tax credits for which no deferred tax asset is recognized, and the amount of a deferred tax asset and the nature of evidence supporting its recognition. Remember, if you have a deferred tax asset, then you're basically saying that I am going to have future profits against which it will reverse, and therefore you need to give an explanation, the evidence that supports. Finally, let's look at leases. What is deferred tax implications of leases? We've decided to include this in our training today because obviously IFRS 16 is a new standard, and it's something that we are implementing. You're implementing at the moment, and therefore you're going to be having questions around the deferred tax implications of the leases. So from 1 January 2019, leases are required to recognize right of use assets and lease liabilities for all leases with some exceptions. So there's exception, for instance, for short-term leases, if a lease is less than 12 months, or leases that have low value items, and so on. Now, IFRIC had a staff paper in June 2018 in this regard. The project has been deferred with regards to tax base of assets and liabilities. So the issue, carrying amount is equals to the right of use asset minus the lease liability. So if tax relief is granted on lease rentals paid, then a temporary difference arises, as the tax base of the lease is zero. So you imagine a situation as it is commonly elsewhere, is that for operating leases, so you're renting a building, the amounts that you pay on a monthly basis or the amounts that are contractual are the only things that you're allowed to claim as an expense. Now here comes IFRS 16, and IFRS 16 says that you need to have an asset or a liability. So in other words, you need to you'll have an asset and a liability. In other words, a right of use asset and a lease liability. The tax base is zero, and the temporary difference arising is the difference for the right of use asset and for the lease liability. The outcome is therefore a deferred tax asset. Now, initially, the lease rental paid is less than the depreciation on the right of use asset plus the finance cost. Future tax saving arises on the additional accounting deduction, which is recognized now, based on the accrual concept. Now, the deferred tax asset is measured as the carrying amount is the right of use asset plus the liability, and we've got the tax base, and we've got the temporary difference. The tax base is zero because as lease payments are deducted when paid, and therefore we end up with a tax liability. The deferred tax asset is going to be the tax rate multiplied by the temporary difference. So here's a case study. Alex leases equipment under a 5-year lease on 1 January 2018. The useful life to Alex is 4 years. Now, the annual lease payments are $8 million payable in arrears each year on 31 December. As at the end of the lease term, the legal title rests with the lessor. Alex has incurred $800,000 of direct costs of setting up the lease. Now, if you know about IFRS 16 lease accounting, we say that the initial costs to enter into a lease are usually added to the right of use asset. So that would be included in our right of use asset. It would be credit bank or credit creditor and debit right of use asset. Alex can claim a tax deduction for the annual lease payments and lease setup costs. Now, those costs, $800,000 in terms of IFRS 16, right of use asset would depreciate it over the useful life, whereas we are saying for tax purposes, you claim it immediately. Now, assume the interest rate implicit in the lease is around 12% and a tax rate of 15%. Cumulative discount factors are given for $1 of 3.0373 and 3.6048. So this is actually to enable you to work out the present values by multiplying by those factors. Now, discuss the accounting treatment for the year ended 31/12/2018. Work to the nearest 0.1 million US dollars. So 8 million at the end of each year, useful life 4 years. We incurred 800,000 direct costs setting up the lease, and then we've got the interest rate that's been given to us. Great. So let's look at the answer. Initially, the right of use asset is going to be we've got 28.8 million as a liability, so that's a discounted amount that's been worked out. Now, what is a right of use asset? It should be equal to our lease liability on day one. But what happens? Remember, we said we capitalize the 800,000 because that's the initial setup cost. So we would have debited our right of use asset. So we find our right of use asset, our ROA, is 29.6 million at the beginning of the year. So if we depreciate it during the year, because it's being written off over 4 years, we end up with 22.2 million, because it's 29.6 divided by 4. That is the amount that would be written off in year 1. Our lease liability, we've been given the discount factors, is 28.8 million plus 12% times 28.8 less 8. We have a discounted amount of 24.3 million as our end of year lease liability. Our deferred tax asset, we've got a liability of 24.3, and we've got a right of use asset of 22.2. The difference between the two is 2.1 million. We multiply that by our tax rate of 15%. We end up with a deferred tax asset, because it's an asset because our liability is higher than our right of use asset, is $0.3 million. Sorry, at the top there is just giving us how we ended up with the 29.6 initially. So our lease rental, depreciation on right of use asset plus finance cost. Lease rental, we paid 8.8. Remember, we're told we pay 8.8 at the end of each year. Our depreciation on the right of use asset, this is what's going through an income statement, is 29.6 divided by 4, which is 7.4. Our finance cost is 12% times 12.8 to 28.8. Remember, it's our interest rate implicit in the lease, times the 28.8, our initial lease liability, is 3.5. So we paid 8.8, which is what the taxman is allowing us as a deduction. Our depreciation is 7.4. Our finance cost is 3.5. So if you look at our expenditure is higher than what is being allowed to us as a deduction, because it's 10.9 if we add up those two figures. Therefore, it means we've got a difference of 2.1 between the two. We've expensed too much as compared to what our taxman is allowing us. So our accounting profit is lower than our taxable profit, which means, therefore, that in future we are going to have a tax expense. And therefore, that means that's how we end up having, in future we are going to have an asset because we've expensed too much. In other words, we've reduced our profit too much. In future, we're going to have more profit. So we end up having a deferred tax asset as a result of that, which is basically a credit to our income statement and a debit to our statement of financial position, because our expense is higher, our accounting profit is lower, and therefore our accounting profit in future is going to go up, and therefore we have a deferred tax asset. And that, ladies and gentlemen, as I said, we've ended up a bit earlier than expected. That's in terms of the IFRS 16 questions. You're welcome to pose them. I've tried to respond as they come through on the platform. Feel free to shoot a few more questions, and we'd be happy to respond. And those are basically our contact details. If you have any further queries, you can be able to email us. That's our telephone numbers here in South Africa, Mauritius, and in the UK. So feel free to post your questions. I'd be happy to respond to them on the platform.